How do some of the top investment advisors in the world suggest to invest your money with index funds to gain passive income and get an annualized return of around 10% over the long term? Let's find out in this video. In part one, we're going to be talking about the differences between stocks and bonds. How many should you choose? How do you balance your portfolio? How do you divide your portfolio up into the proper proportions and allocations that are perfect for you, your goals, your age, and your overall current situation in your life? How do you know about how much risk you should take? And how do you minimize your risk? It's actually not as complicated as you may think. In truth, it's pretty easy. It doesn't take very much work or research. In fact, the portfolio structures that we are going to be discussing today are known as the lazy portfolios. This means you get to be lazy and still potentially earn around 10% annually over the long term. Last year, in 2017, some of these portfolios earned almost up to 20%. And at that rate, you can double your money in less than 5 years. There's a few things you need to know before you venture out and set up your portfolio of passively managed index funds. Let's get started. So at its most basic level, every investment portfolio is divided up into two basic categories. That's more risky investments and less risky investments. In other words, stocks and bonds. So now you ask, how much of your portfolio should be allocated between, on one hand, stocks and on this hand, bonds? Okay, so to find that out, first we need to talk about what is the major difference between investing in stocks and bonds. A stock is a share of ownership of a company that represents a claim on the company's assets and earnings. A bond, on the other hand, is not a share of ownership. It's a loan to an entity, typically corporate or government. The loan is for a fixed period of time that pays interest, usually semi-annually or annually. Now, when this loan or bond reaches its maturity, the full amount of principal, all the money you put in at the beginning, is returned to you, and you get to keep all the interest that you earned along the way. Stocks are more risky and volatile than bonds and also have a higher earnings potential. Bonds are heavier than stocks. They are less volatile and less risky. They generally grow at a much slower rate than stocks. Bonds pay interest. Stocks pay dividends, or they pay nothing at all. In a bad market, bond prices tend to rise because people are selling off their stocks to buy bonds. Therefore, bonds help weather the storm of a stock market crash and plummet. So when the market crashes, portfolios that contain bonds will not crash as hard. Portfolios that contain bonds will be on a much smoother ride than portfolios that contain mostly stocks. Bonds are known to stabilize your portfolio a bit like stock insurance. Bonds are also much less risky because they have mechanisms in place that keep the interest rate fairly constant. Most bonds pay the investor a fixed rate of interest income that is also backed by a promise by the issuer that the investor will be returned their initial principal investment once the bond matures. Therefore, since bonds are less risky and less versatile, they're used to balance out your portfolio against the more risky and more versatile investments like stocks. So, the first thing you need to do when building your portfolio is to decide what percentage of my portfolio will be in bonds and what percentage of my portfolio will be in stocks. Now, to figure out how to do this, keep watching. What's up, everybody? I hope you enjoyed part one of this video. If you haven't watched it, be sure to go check it out. Stick around for part two to learn about several strategies to figure out exactly how much of your portfolio should be stocks and how much of it should be bonds. Now, to figure out how much of your portfolio should be in bonds and how much should be in stocks, there's three basic questions you can ask yourself. One is your age. Two, what is your investment horizon, or when do you want to draw on these funds? And three, what is your risk tolerance? Now, when you're younger, you can take more risks with your investments. Just because if the stock market crashes and plummets, you have more time to wait and let it recover. If you're older, you may want to draw on those funds in 5 to 10 years. But you want to make sure that the market is not down when you withdraw your investment. So the closer you are to wanting access to your investment funds, the more bonds you should have in your portfolio. If you have a high risk tolerance, you're going to want to put more stocks in your portfolio. If you have a low risk tolerance, you're going to want to put more bonds in your portfolio. So here are many ways that you can set up your portfolio allocation between stocks and bonds. 100-0, 90-10, 80-20, 70-30, 60-40, 50-50, 40-60, 30-70, 25-75, 20-80, etc. So I've pulled 5 basic strategies on how to allocate stocks versus bonds based on your age and personality type. First method is called the conventional method. The classic recommendation for bond stock allocation ratio is to subtract your age from 100 to find out how much you should allocate towards stocks. So here is a chart for the conventional method. As you can see, from age 0 to 25, you're still going to keep 100% of your assets in stocks. And then after 25, you're going to subtract your age from 100. So at age 30, 70% of your allocation is in stocks and 30% is in bonds. At age 35, 65, 35. At age 40, 60% of your assets are in stocks and 40% are in bonds. At age 45, 55, 45, all the way until you're 75 and you're 25, 75. The pattern just continues. The basic premise of the conventional method is that we become more risk averse as we age, given that we have less of an ability to generate income. We also don't want to spend our older years working. We are willing to trade higher returns for greater certainty. Method number 2 is called the new life allocation. The new life allocation suggests you subtract your age by the number 120 to decide how much of your portfolio should go towards stocks. Now, as you can see, this new life portfolio is already less conservative. So here's a chart that shows the asset allocation for the new life model. Again, from 0 to 25, you're going to put 100% of your assets in stocks just because you have the long investment horizon. And then by 30, you're going to start subtracting your age by 120. So 120 minus 30 is 90. Therefore, you put 90% of your assets in stocks and 10% in bonds. The pattern continues until you're 75. 120 minus 75, you put 45. It equals 45, so you put 45% of your assets in stocks and 55% of your bonds, and the pattern just continues from there. Now, due to advances in science, and also because our society is becoming more aware of eating healthy and what is good and bad to put into your body, people are generally living longer. Now, given that stocks outperform bonds over the long run, we need a greater allocation of stocks to cover our longer life. Method 3 is called the survival method. The survival asset allocation model is made for those who are risk averse, who do not like to take risks. This is why it is called the survival method. Okay, everyone, so here's the survival method. Again, from 0 to 25, 100% in stocks because your investment horizon is so long. But when you hit 30, then you're gonna make a big adjustment into bonds, 70% to 30% stock bond ratio. And then once you hit 35, you're just gonna go 50-50 because you're just in this to survive. Your attitude is survival and you're risk averse. You're not taking any risks. Then by the time you get to 75, you're gonna put even more of your assets into bonds just to protect them while you're in retirement. This allocation increases the chances of your portfolio 50-50 in stocks and bonds, outperforming most other more risky portfolios in a market collapse. This is because as investors flee the stock market towards bonds, the bonds that you already own will increase in value. Okay, stock bond portfolio allocation number 4. This is the nothing to lose method. Given that stocks have outperformed bonds consistently over the past 60 years, the nothing to lose asset allocation model is for those who want to go all in on stocks. All right, for all those risk takers out there, this is the nothing to lose model. In the nothing to lose model, you go 100% in stocks until you are age 50. At age 50, you go 90-10. At age 60, 80-20, and age 70, you go 70-30. 30. So this is for everyone who just wants to ride the wave of the market and says, screw bonds, I'm going to take more risk. My portfolio is going to be much more volatile, but I'm a risk taker and I'm ready to ride the wave of the market and hopefully see greater returns. If you are young and have a long enough investment horizon, this method may suit you well. And method number 5 is the financial samurai asset allocation model. The financial samurai model is a hybrid between nothing to lose and new life. If you predict that a new normal will come to be where stocks return an average of 5 to 7% annually and bonds start returning 4 to 5% annually, this model makes sense for you. So the financial samurai model balances the more risky nothing to lose profile with the slightly more conservative new life model. As you can see, from age 0 to 30, we have 100% in stocks. From 35 to 45, we have 80% in stocks. From 50 to 60, we have 70% in stocks. 65 to 70, 60% in stocks. And at age 75 and above, we're just gonna split our portfolio 50-50 stock bonds. Now, once you're in retirement, I do wanna point out that it is slightly risky to keep 50% of your profile in stocks. But that is why this model is called the financial samurai. So a couple additional points here that I want to add. The S&P 500 has been extremely volatile over the past 20 years. The golden age was between 1995 and 1999. From 2000 to 2002, we saw 3 years in a row of double-digit declines. That's pretty scary. This was followed by 4 years of gains until the 2008 economic crisis. There tends to be a 3 to 5 year run until performance reverses. Another additional point is that last year in 2017, this was a banner year, an incredible year for the stock market, which closed almost up 20% from the previous year. 2018 has started off very solid as well. Okay, so now what you need to do is pick one of the models that is suggested, and you can always tailor it to your own personality and your own ideas about what the future could bring. You can use one of the 5 models just to decide how you should allocate between stocks and bonds. What's up, everybody? I hope you enjoyed parts 1 and 2 of this video. These 2 videos were just setting up part 3, which is the really interesting stuff about how to allocate all the different index funds you invest in and how to set them up, how many to buy, and in which proportions should they be in your portfolio. So that's coming up in part 3, and I'm going to be releasing that video in a couple days, so stay tuned. If you found any of this information helpful or valuable, please smash that subscribe button, hit the thumbs up, leave a comment, let me know what you think about it, and I'll see you all in part 3.